Ever scrolled through like financial news, and seen those headlines? Someone turning like a tiny investment into a fortune practically overnight with options trading. Yeah, we've all seen them. We've all been tempted. But let's get real for a sec. It's not just about chasing, those big wins. It's about not losing your shirt, right?
Yeah.
That's what we're diving into today. Those rules that can help you approach options trading with a little less risk and a lot more strategy.
That's exactly it. This isn't about gambling on the next hot stock tip, It's about building a sustainable approach.
Yeah.
And like anything worthwhile, that takes some discipline.
Yeah. Okay, so let's unpack that discipline a little bit. The sources we're looking at for you stress focusing on just a handful of stocks, like 3 to 5 max, for at least 6 months. 6 months. That feels like an eternity in the fast-paced world of trading. Why is that so important?
Think of it this way. You're not just trying to memorize stock symbols, right? You're trying to deeply understand how those companies operate, how they react to market shifts, what their patterns are over time. That kind of deep knowledge only comes from like consistent, focused observation.
It's like becoming a regular at a coffee shop.
Right.
Yeah. At first, you're just overwhelmed by the menu, all the drinks. But over time, you learn the barista's name. You know exactly how they make your drink. You pick up on those rhythms of the place. You become comfortable, even insightful in that environment.
Yeah. And just as importantly, it helps you avoid what I call the trading tourist trap.
Oh, okay.
You see a flashy headline about some company you've never heard of, and suddenly you're convinced you need to be a part of it. That's FOMO, the fear of missing out, and it can be a killer in the markets.
So focusing on a few key players helps you tune out that noise and stay focused on your own plan.
Exactly. And speaking of plans, the next crucial rule we need to dive into is all about protecting what you've got. Let's talk risk management.
Yeah, this is where the rubber meets the road, right?
Yeah.
It's not just about picking the right stocks. It's about understanding how much risk you're willing to take on each trade.
And a huge part of managing that risk starts with something called liquidity. Essentially, it's how easily you can buy or sell an option without, drastically affecting the price. You want options with high volume, meaning lots of trading activity, and healthy open interest.
So open interest, is that like how many people are currently holding that particular option contract?
Precisely. High open interest suggests there's a good amount of attention and potential buyers or sellers for that option. Now, another crucial aspect of liquidity is the bid-ask spread.
Okay, break that down for me. What's the spread and why does it matter so much?
Think of it as the difference between what buyers are willing to pay for an option, the bid, and what sellers are asking for it, the ask. A wide spread, meaning a big difference between the bid and ask, can eat into your profits, even if you predict the stock move correctly.
Yeah, one of the sources we reviewed even had this scary stat. A wide bid-ask spread can instantly wipe out 20% of your potential profit. Just like that. That's a huge chunk of change.
It absolutely is, and it's a risk many new traders don't even realize they're taking.
It's like trying to buy like a rare comic book.
Yeah.
If there's only one seller and they know it's in high demand, they can charge an arm and a leg, right?
Exactly. So when you're looking at options contracts, you want to focus on those with a tight bid-ask spread.
Yep.
It means you're not losing, a big chunk of your potential profit just from the cost of doing business.
That makes a ton of sense. Now, what about those far out of the money options we hear about? The ones that seem too good to be true, like making 500% gains in a day.
Ah, yes. The siren song of options trading. It's true. Those options have the potential for massive gains because they're so cheap to buy. But here's the catch. They're cheap for a reason.
Because they're incredibly risky.
Precisely. Think of it like this. You're essentially betting that the underlying stock will make a huge move in a very short amount of time.
And the odds of that happening are about as good as winning the lottery?
Pretty much. And then there's the silent killer of options trading, time decay. Options contracts have an expiration date, and as that date approaches, the value of the option starts to erode, especially for those short-term contracts. The ones known as weeklies.
So even if I'm right about the direction of the stock, if it doesn't move far enough, fast enough, I'm still losing money because time is literally working against me.
Exactly. That's why our sources recommend opting for options with at least 3 weeks, if not more, to expiry. It gives your trade more breathing room, more time for the stock to move in your favor.
So to recap, liquidity, bid-ask spread, avoiding those far out-of-the-money gambles, and understanding how time decay works, it's all about protecting your capital so you can actually stay in the game for the long haul.
Absolutely. Now, let's say you've got a handle on all of that. You're choosing liquid options, you're managing your risk on individual trades. The next piece of the puzzle is managing your overall exposure. And that's where position sizing comes in.
Right, because even if I'm being smart about each individual trade, if I'm betting my entire account on every single one, that's not exactly a recipe for sustainable success.
Not at all. One of the most common rules of thumb we see repeated throughout these sources is the 3% rule.
Okay, so never invest more than 3% of your total account balance on a single trade. What I find interesting is that the source material emphasizes that this 3% includes any additional shares you buy to average down if the trade moves against you.
Yeah, it's a crucial distinction because even if you start with a 3% position, if you keep adding to it as it goes down, you can quickly end up with a much larger exposure than you intended.
Let's say I've got like a $10,000 account and I put 3% or $300 into a trade, but then it dips and I think, oh, it's a bargain now, and I throw another $300 at it. Suddenly I'm at 6%, and if it keeps going the wrong way...
You get the idea. It can snowball, like really quickly. And remember, it's not just about managing your exposure on a single trade. It's about managing your overall market exposure.
So how much of my portfolio should I have actively invested in options at any given time?
The source material we've reviewed for you suggests aiming for no more than 15% of your capital exposed in a single market direction. Essentially, you're diversifying your risk, spreading it out so that one bad trade doesn't wipe you out.
It's like that old saying, don't put all your eggs in one basket.
Exactly. But here's the thing. Even if you have the perfect risk management strategy, the perfect position sizing rules, there's one more element that can make or break your success as an options trader.
Okay. I have a feeling you're about to talk about the mental game.
You got it. All the logic and strategy in the world won't help you if you can't control your emotions.
Because it's so easy to get caught up in the moment, right? Like when you see a trade going your way and you get that rush of excitement, or worse, when you see it going against you and you panic.
Exactly. And that's where things like revenge trading come into play. It's this primal urge to win back what you've lost, to chase those losses, and it almost always ends badly.
Oh, I know that feeling. It's like, the market can't beat me, I'm going to show it who's boss, and then, your account balance ends up looking like it went through the washing machine. Not pretty.
That's why one of the most important rules we see emphasized throughout these resources is to have a system, a set of predefined rules that you follow religiously, no matter what your emotions are telling you.
So it's like having a trading plan written down, and then no matter what happens, you stick to that plan, even when it's tempting to deviate.
Precisely. Think of it like learning a martial art, You don't just walk into the ring and wing it based on how you're feeling at that moment, do you?
Definitely not if I want to avoid, a swift knockout.
Exactly. You train, you practice, you develop discipline, and you stick to the techniques you've learned, even under pressure. Trading is no different.
That's a really helpful analogy. Speaking of learning, the sources we're reviewing also highlight the importance of paper trading, especially when you're first starting out. What are your thoughts on that?
So it's like practicing my moves in a safe environment before I step into the real ring with, real money on the line.
Exactly. Paper trading lets you test your strategies, get a feel for the mechanics of options trading, and, most importantly, make mistakes without it costing you a dime. It's the ultimate learning tool.
And it's a great way to practice that emotional discipline we were just talking about, right? Because you can see how you react to different market conditions without the pressure of real losses. Precisely. Now, speaking of learning, there's one more crucial concept we need to cover: continuous improvement. Options trading isn't something you master overnight. It's a journey. And the most successful traders are those who are committed to constantly learning and refining their approach.
So it's not enough to just learn a few strategies, place some trades, and hope for the best.
Not if you're serious about making options trading a sustainable part of your financial journey. Our sources emphasize the importance of journaling, of tracking your trades, not just from a numbers perspective, but also from an emotional one.
So I should be writing down what I was thinking, what my rationale was for each trade, how I felt during the process.
Exactly. Because when you go back and review your trades, you're not just looking at, what worked or didn't work from a technical standpoint, you're also analyzing your decision-making process, identifying patterns in your behavior, understanding how your emotions might be influencing your trades.
That's such a great point. It's like having a conversation with your past self about your trading decisions.
Precisely. And through those conversations, you start to identify your strengths, your weaknesses, and those moments where you might be letting emotions cloud your judgment.
And that's where those moments happen, those breakthroughs that help you become a more disciplined, more profitable trader.
Exactly. And here's the thing. Continuous improvement also means being willing to admit when you're wrong, to accept losses as part of the process.
Yeah, that's often the hardest part, right? Nobody likes to lose, especially when it comes to money, but it's an inevitable part of trading.
It is. And our sources emphasize that one of the biggest differences between successful traders and those who struggle is how they handle those losses.
So it's not about trying to avoid losses altogether. It's about learning from them and using them to improve your strategy over time.
Precisely. Now, there's one final concept I want to touch on before we wrap up this deep dive. Letting go of the need for perfection. Options trading, like life, is full of uncertainty. You can't control everything, and sometimes the best trades are the ones you don't make.
That sounds almost counterintuitive in a world where we're constantly bombarded with information and urged to take action.
It is. But one of the most valuable skills you can develop as a trader is the ability to discern between opportunities that align with your strategy and those that are simply distractions.
So it's about trusting your gut, sticking to your plan, and not getting caught up in the hype or fear that can often drive market sentiment.
Exactly. Remember those rigid profit goals we talked about earlier? Letting go of perfectionism means being flexible, adapting to changing market conditions, and accepting that sometimes a small win is better than a big loss.
It's about playing the long game, focusing on sustainable growth over time and not letting those short-term fluctuations throw you off course.
Precisely. Options trading can be an incredibly rewarding endeavor, but it requires patience, discipline, and a commitment to continuous learning.
Well said. As we wrap up this deep dive into the world of options trading, I have to say I'm walking away with a whole new appreciation for the level of strategy and mental fortitude it takes to succeed.
Yeah, it's definitely not for the faint of heart, but for those willing to put in the work to master the fundamentals and cultivate that, crucial balance of analytical thinking and emotional discipline, it can be a truly rewarding journey.
If you're just starting out on your options trading journey, or even if you've been trading for a while but haven't yet found the success you're looking for, remember this. It's a marathon, not a sprint. Focus on building a solid foundation of knowledge. Develop a system that works for you and never stop learning and refining your approach. Thanks for joining us on this deep dive into the fascinating world of options trading.